Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hey, Matt, thanks for the great introduction again. And Mark and I got some really good topics to discuss today. We're going to talk about biases. And actually, we're writing a series of papers on these. We have our top 6. And I figured that we could knock down the first 3 here in this podcast. Mark and I are going to go through number 1, loss
Numero
aversion.
uno.
You got it. And this is one of the toughest ones to come over. To get over, I should say, loss aversion bias, number 1. Number 2, Mark, is narrow framing. How do you like that?
Love that.
And then number 3 is anchor bias. So those 3 are distinctly different from one another. However, they are biases that when you don't have clarity, they derail your actual objectives. And my goodness, there is carnage on the side of investors' roads these days because they do not understand their process. And quite frankly, they don't even have one. Why don't we take it from the top here? What I'm going to do is I'm going to kind of give the academic definition, if you will, of these. And then I want you to speak to these because you have done a fabulous job over the last 20 plus years in really bringing these to light. So here's the first one. Known as the fear of loss. Now, just that word loss, I want you to hold that thought. Remember about how you used to say you don't have a loss until you make a sale, but correct. Known as the fear of loss that leads to a withdrawal of capital at possibly the worst time. This bias is also known as panic selling. Loss aversion bias is a powerful emotion that investors need to learn to control. Unfortunately, investors have a very poor track record, aka the Dalbar study, in that regard, and have repeatedly demonstrated one of the primary byproducts of this bias, selling their assets while the prices of those assets are going down. So I want you to talk a little bit about that, the relationship of funds and ETFs and not knowing what you know, what you own, and take it from there, my friend.
Okay. So there's a lot there to unpack.
Right.
Loss and aversion bias is one of the biases that the financial services industry uses a lot because there's been study after study that shows that investors buy at quote unquote market highs, they sell at quote unquote market lows. You don't buy into a market. I've said it 1,000 times. Let me say it again. You don't buy into a market. You invest into a business or businesses. The problem is that most investors buy exchange traded funds and mutual funds that are buckets of stocks, buckets of investments that they have no idea what they're buying or selling. So when it comes to the point of loss aversion, in their mind, they're not viewing the fact that they're selling high quality businesses. They're viewing it that they're selling a bucket of something that they don't understand. This is why we've said on multiple podcasts before, investing is about investing in great businesses, not the stock market. The stock market is nothing more than the greatest tool ever created to bring buyers and sellers of businesses together for people to take advantage of long-term investing and capital appreciation. So my problem with the whole idea of loss aversion is, problem is probably the wrong word. My biggest love for loss aversion is the impetus of the word Nepsis, which is why I decided to change the name of our firm years ago to Nepsis, which means ultimate clarity. Why is ultimate clarity important? Because when you have the ability to know what you own and why you own it, the idea of loss aversion goes away. People sell great businesses all day long, and they have no idea why they're selling it in the first place. So as it pertains to the quote unquote stock market, investors think that they invest in the market, not in businesses. So because of the pain they feel when they're losing money, even though they haven't lost anything, because you don't lose money until you sell. They don't have clarity on what they own and why. This is the foundational component of Nepsis. Ultimate clarity, the ability to look and see the businesses you own. Now, some people can look at the businesses they own and they still say, you know what, I'm going to sell it. Well, they probably shouldn't have been investing in the first place. The stock market was created to bring buyers and sellers of great businesses together to invest long term. And when you have the kind of pain we're experiencing in 2022, many people will quote unquote throw in the towel because their mindset is, I'm investing in this huge opaque bubble they call the stock market. But they're not. They're investing in businesses. And the benefit, of course, at Nepsis is we know exactly what businesses we own, and we can pinpoint where we want to buy more of those businesses that, by the way, are profitable, pay dividends, and are great long-term investments. That is the foundation, Chuck, of investing with clarity.
It sure is. And I want to wrap this first of the three up with two things you said I thought were just immensely important. How can one have, and I'm going to ask two questions, so let me go through the first two here. So how can one actually have conviction in a mutual fund or an ETF? And I would argue that they can't. So I want to talk about the conviction component. And then the other thing you said, which was amazing, because psychological studies have shown that the emotion garnered with a loss, that's a loss of anything, whether it's a loss of life, of a family member, of money, losing in a sporting event, that emotion is twice as strong as what is garnered by a gain or by joy. So for whatever reason, whether we were created that way or just our nature going through the world we have, that is so difficult to overcome. So how do you gain conviction? And then actually, how do you, at the end of the day, realize that your own worst enemy and that strength of loss is twice as great as that strength that's gained through any type of winning event?
Yeah, we have created call it a little bit of some IP on what we call the conviction indicator. So with our investment committee, we have created a process that is what's referred to as our conviction indicator. And ultimate decisions that are made in the businesses that want to be owned every single one of them have a level of conviction. And that conviction can be as high as 10, and the conviction can be as low as 1. Okay. And there's different businesses based on different criteria that bring us to what we call the conviction indicator. We don't publish returns. We don't focus on it. We focus on the process. The process includes the conviction indicator. Clarity allows us to transform that into a conviction level. And that conviction is what enables us to tighten our asset allocation strategy, how we approach the businesses we own. When you think about the average investor who owns mutual funds and exchange traded funds, they have no idea what they own. They don't think like a business owner. They think like a stock market investor. Nepsis is about investing like a business owner, not the stock market. As I said earlier, stock market is nothing more than the greatest tool ever created to bring buyers and sellers of businesses together.
Superb. Now we're going to go to number 2 here, Mark. And this is narrow framing bias. And again, I'll tee it up here. I'll read kind of the academic, if you will, definition. And when we first joined together here 17 years ago, I thought you did a great job, with this analogy of a vehicle, right? Car, truck, and how it operates. So let me read this here.
That one.
Yeah, you'll love that. I know that you do. So here's the definition. Bias can be defined as one that encompasses making decisions about part of an investment portfolio without considering the effects they will have on the portfolio in totality. Now, I added this piece. For years, we have used the analogy of an automobile when addressing the effects of this bias, as it helps one to see the interconnectivity of the many parts that need to work in harmony for the constructed item to achieve its purpose. How do you like that? So
I actually love that.
but I know that you, so go right ahead with this, because you're going to talk about the tires and the steering wheel and the battery, et cetera. So take it away, my friend.
Well, let me step back for a second and make a comment about in the times we're in right now in terms of how bad equity markets have performed and how bad fixed income, i.e. bonds, have performed. And I've always talked about risk-adjusted return. How much risk do you take to make the return you're going to make in every aspect of the portfolio? But at the end of the day, asset allocation still is the most important aspect of investing. And where I think the industry is messed up and where the industry does not have it figured out is that the industry views asset allocating as a cookie cutter style box style process, modern portfolio theory. But the reality is that asset allocation is more about the structure of the investments in the portfolio and knowing what you own in the portfolio and how each component in the portfolio works together or against all the other components. So to put it in layman's terms, it's 2022. We have advisors that work for us, advisors that talk to us who say, how can it be that your portfolios are down so much less than everybody else? How come you're down X? Everyone else is down between Y and Z. I thought actually last week at one point we could go positive on the year, which would have been nuts, right, Chuck?
You got it.
So people thought bonds were conservative. People have lost a ton of money in bonds, and we own no bonds. Yet the performance of the portfolios are substantially better than the overall markets. Okay. So why is that? Asset allocation, knowing what you own and why you own it, and creating a portfolio where all the pieces of the portfolio work like a fine oiled machine gets to the automobile analogy. How many people go out and buy a car? They kick the tires. They look at the beautiful leather seats. They see it's got power windows. They see it's got a great stereo. And that's all great. That is what they refer to as the aesthetic view. It looks shiny and pretty. And they know that because it looks shiny and pretty, when they sit down in the car, they don't know who made the spark plugs. They don't know who made the air conditioning. They don't know who made the tires or the brakes or the seats. All they know is that when they press the button or turn the key, the car starts. And that's how we live. We don't have clarity on all the components of the car we're buying. We just know that when we turn the key or press the button, the car works. But all those pieces work together to accomplish the goal of when you get to that point of turning the key or pressing the button, you know the car works. Investors live in the exact same world. Just take crypto. It's all shiny. The tires are clean and pretty. It's got nice leather seats and it all looks good. And then they buy it and they drive a block down the road and the car breaks down and dies. Right? Because the asset allocation or all the components that are put together are not working in unison. And that's what the Nepsis portfolios do.
Mark, you nailed it. I want to leave our audience with one more thought on this, because again, it's a Mark Pearson quote that should be etched in stone, and it wraps up this narrow framing bias. And we'll get to anchor in a second here, but you've said this for years. and I want you to end on this for this piece, if you don't mind. No one position should make or break the portfolio. How many times are you and I in our committee questioned, why do we own X, Y, Z? Why do we still own A, B, C? And we don't have to fill in names of those. And people tend to look at these on a position by position basis, not how they interact. So finish on that, if you wouldn't mind, my friend. No one position should make or break the portfolio. I love that comment.
It's kind of like putting tires on your car. You can go with Firestone. You can go with Pirelli. You can go with Michelin, but the tires are just a small component of the car. There's lots of other pieces. If you didn't have the engines, the steering wheel, the starter, the seats, the brakes, it doesn't matter what tires you put on your car. It's the same with every position that's owned in the portfolio. No one position is going to break the performance, the ability to drive your car, the ability to drive your portfolio. Every position is owned for a specific reason. There is a buy discipline. There is a sell discipline. There are metrics to every piece of the portfolio we own. This is why we only own 25 to 35 companies. If you really think that portfolio managers have the ability to understand 100, 200, 300 positions sitting in their mutual fund or ETF portfolio, you're fooling yourself. It's cookie cutter. It's that simple. And the fact of the matter is that studies have statistically shown over and over again, it is diversification, not over diversification. It is asset allocation, not over asset allocation. You don't care when you buy a car. I mean, Chuck, have you ever actually asked whose tires are on the car? Nope.
No.
But guess what? If the tires don't work, you ain't driving it off the lot.
Got that right.
And so at the end of the day, portfolio management is the same. This is your money you work hard for. The power of clarity, the ability to understand everything that's going on with your portfolio is a foundational advantage to enhance, hopefully, your ability to accomplish your financial goals.
Beautiful, Mark, as always. So we got one more to go here, and this one fascinates me because I'm going to tee it up and I'm going to give you two examples, and I'd like you to speak to both these because we deal with this all the time. So this is anchor bias. I'll just read the definition to our audience here. It's actually a term used in psychology that describes the common human tendency to rely too heavily or anchor one trait or piece of information when making decisions. So we also call it confirmation bias, where people will only seek out either a certain news media or various venues to confirm their anchor bias. So here are two of these that we deal with, and I'd like you to talk about. The national debt. How can we continue to invest in companies? Shouldn't I be buying gold? The national debt has gotten too high for anybody to invest. The stock market's going to crash. That's number one. And number two, which has really become, I think, an insidious bias, is the political polarization that we see in our country, where, let's say you're a registered Democrat and a Republican is in office, you see the economy as much worse than it is. And when a Democrat's in office, a Republican sees the economy as much worse than it is. How do investors overcome this anchor bias where they free themselves, they can see the truth in front of them, and show how that clarity piece actually allows people to be freed from anchor bias?
Do you think Visa or MasterCard care who's in office?
You boy, you're on fire today. Of course not.
Exactly. Do people still need to drive their cars?
Yes, sir.
People still need to buy clothes. The people still need to go to work.
I think so.
People still want to be entertained. We're talking about the precipice of recession, this, recession, that, recession, this, recession, that.
Obsession, right?
Why is it obsession? Yeah.
Yeah, recession, obsession.
And why is it everybody is still traveling immensely, going on vacation like nothing's going on? People continually want to listen to talking heads, prognosticate, postulate, and speculate about what they think is going to happen. I'm going to tell you, I'm going on vacation next year. You know what? I did not consult any of the talking heads I listened to babble on TV as to whether or not I should go on vacation. Great companies with great leadership, they adjust. If you have a great product or service that people need or want, they adjust. Jim Cramer always says there's a bull market somewhere. I fundamentally believe that. And if the management doesn't do their job, all I've been hearing today, all day on the TV, is about Bob Iger coming back to Disney because the last CEO didn't do the job. They canned him yesterday, and all of a sudden he's back at Disney and the stock's up 7%. Companies will adjust. Great run businesses will adjust. Invest in great businesses over time and don't listen to the prognostications, postulations, speculations, and all the other crap that you hear people give you their opinion about to you. Stick to clarity. Stick to the.
I love it, Mark. And I'm going to end on this note here because I remember the story that you told me. This was back in the financial crisis, and we were getting bombarded with, hey, Armageddon's at our front door. The world's over with as we know it.
Yeah.
And you basically said, hey, I drove my vehicle out today. I went to fill up my tank, and I can mention some names here because we may or may not own these anymore, but
swipe my card,
swipe your Visa. I had Verizon as my phone carrier, and I was filling up my tank with whatever the oil companies got. Exactly. And we owned all three of those stocks. So tell a little bit just about how people, and they may not have a process, but just looking around their homes and what they buy, what they seek out, the iconic brands, and talk a little bit about that, how that is weaved into the psychology.
Well, first things first, just because you're a great company does not mean you're a great investment. That's number one. Remember that. Just because you love something, just because they have something that's great, just because you think it's a great company does not mean it's a great investment. I used to use the analogy of Walmart. Walmart may be a great company. Certainly Walmart does lots of revenue, but there was probably a 20-year period where Walmart stock didn't do anything. It was flat. Great companies are not necessarily great investments. And this has happened over and over again with many companies. So it's not as linear to think about if this, then that. It's more if this, then this and this, which is why you should have a professional, which is why you should hire an advisor, which is why you should invest with clarity. Because for most people, the variables are too great. And you may get lucky, and there's nothing wrong with getting lucky, but don't misconstrue luck with skill. Don't misconstrue luck with investing in a great business, because there's a lot of real crappy businesses whose stocks have done very, very well. You look at crypto, you look at everything going on. Everyone thought crypto was super great. Look at it now. And there's company after company that were here yesterday and gone today, right? I mean, how many companies can we think of that were, in fact, we should find the old study, Chuck, of the companies that made up the Dow 30 in 1929. And what's the Dow 30 today?
Yeah, they're very far and few between as to any that it still exists in that index. You got it.
Flexibility and transparency, the two other legs of the stool to philosophy and strategy for successful investing, are critical to the process of being a successful investor.
It surely is. And I want to end on this note because it was another great story, and I'll pass it back to Matthew. I'm not going to mention the name of the restaurant, but you were approached by a close friend and they said, hey, what do you think of XYZ Chinese restaurant? You're like, oh my goodness, I love the Kung Pao chicken. And he was like, no, I'm talking about the stock.
Oh, wow.
And that just say you can anchor even the taste of something that you like into a good investment where it isn't necessarily one, right? Did I get that story correct?
That's awesome. That's a long time ago.
Yeah.
What do you think of PF Chang's stock?
PF Chang's,
big hot stock at the time. I said, I got to tell you, they got some of the best Kung Pao chicken I've ever had. And they're like, no, I'm talking about the stock. They got some of the best Kung Pao chicken I've ever had. Just because they got good compound chicken doesn't mean it's a great investment to invest in.
Mark, thanks so much for that. Always have so much fun here.
Yes.
I'm going to pass it back to Matt here to close it up for us. But thanks for taking the time as always, my friend. Always a pleasure here.
Great show. Great show. Thanks, Biggie.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.